Warren Buffett, the legendary investor and chairman of Berkshire Hathaway, has captivated the investment world with his remarkable success and unique investment approach. Buffett's value investing approach, characterized by purchasing undervalued stocks and holding on to them for the long term, has allowed him to accumulate immense wealth. Through Buffett's successful investments in companies like American Express, Coca-Cola, and Wells Fargo, his approach highlights its tremendous effectiveness and its potential for investors seeking sustainable long-term returns. In this video, we'll delve into the fundamental principles that make Buffett's strategy exceptional, including his focus on unique businesses, the concept of concentration versus diversification, and the power of long-term thinking. Hello, and welcome back to another video on our channel, Finance Sense, covering all the latest trends in the financial markets and the economy. Buffett uses a value investing strategy and seeks businesses that are selling below their intrinsic value, which is established by their financial assets and future earnings potential. In a simpler way, by purchasing these stocks when they are cheap, he may maximize gains when the market ultimately corrects and the firms attain their actual potential, as he expected, resulting in rising stock prices. Buffett is similarly picky about where he puts his money for the sake of diversity. Buffett favors maintaining a concentrated portfolio of equities, although many investors distribute their money across a variety of companies and industries to lower risk. In his opinion, diversification can dilute rewards and result in subpar performance. He would rather concentrate his investments on a select group of businesses that he respects and believes in. To further elaborate, he spoke with conviction, emphasizing the lack of magic in his investment approach. He expressed a preference for investing substantial amounts of money in businesses that he firmly believed in, linking this philosophy to the concept of diversification. According to Buffett, diversification seemed impractical for those who possessed knowledge and expertise in analyzing businesses, as it primarily served as a safeguard against ignorance. In his view, owning a wide array of stocks seemed illogical when there were only a limited number of truly exceptional businesses that could be comprehended by a single individual. The idea of investing in a magnificent business but allocating funds to less attractive options further puzzled Buffett and his business partner, Charlie, who considered it sheer madness. Buffett challenged the notion that owning numerous stocks was necessary for diversification, asserting that he personally held only one stock, a business he intimately understood and felt comfortable with. He questioned the necessity of owning 28 stocks for proper diversification, deeming it nonsensical. He further expressed contentment with the prospect of owning 3 of their exceptional businesses within his company, Berkshire Hathaway. While he acknowledged the value in discovering and adding more businesses to their portfolio, he believed that 3 outstanding ventures provided more than enough to achieve success. Buffett noted that the average person would rarely encounter such opportunities, citing the historical pattern of wealth creation in the country, which revolved around identifying and investing in remarkable businesses rather than building portfolios with numerous companies. Using Coca-Cola as an illustrative example, Buffett highlighted how fortunes had been amassed by investing in genuinely exceptional businesses. He emphasized that such extraordinary companies were scarce, dismissing the idea that there were numerous equivalents available. He stressed that one did not need an abundance of exceptional businesses to succeed financially, as a genuinely unique company possessed inherent resilience against economic fluctuations and competition. Buffett believed that these select few extraordinary companies, capable of withstanding competition effectively, held less risk compared to a larger portfolio of well-known but average-sized businesses. He expressed astonishment at the prevailing teachings in finance classes that advocated diversification. Buffett confidently declared that if he were to stake his family's fortunes over the next 3 decades, dependent on the income generated by a particular group of businesses, he would choose 3 exceptional businesses from their holdings, rather than a diversified collection of 50 companies. He acknowledged that this approach carried risks, as a significant decline in one of the stocks could impact overall returns. However, he believed that the potential rewards of a concentrated portfolio outweighed these risks. For those who did not have the inclination or ability to analyze individual stocks, Buffett advised investing in low-cost index funds that track the S&P 500, a reliable strategy that would yield average returns of around 7% annually. However, there are risks involved in this strategy. A substantial fall in one of the equities in his portfolio might have a significant effect on his total returns. Yet, according to Buffett, the benefits of a concentrated portfolio exceed the drawbacks. Additionally, he advises most investors who do not want to dedicate their time to researching and evaluating stocks to simply stick with inexpensive index funds that follow the S&P 500, because they will likewise have solid average returns of 7% each year. Now, Buffett used his investment approach to make millions of dollars from Amex, Coca-Cola, and Wells Fargo. First, the salad oil scandal in the 1960s caused a catastrophe for Amex, and as a result, the whole futures and commodities market was almost completely wiped out. As the price of Amex's stock fell, many investors were frightened. On the other hand, Buffett saw this as a chance to purchase a fantastic firm at a discount, in contrast to the other investors who steered clear of Amex. Buffett momentarily disregarded the controversy and trusted his instincts since the company had a strong competitive edge and a devoted client base. He invested a total of $1.3 billion in the company's shares, but stopped in 1995 and kept it. Since then, Buffett's stake in American Express has increased to almost $22.4 billion, a 17-fold increase with an estimated dividend yield of 23%. This is the strength of his value investing strategy, which was then extended to his other investment choices after it had been seen to be successful in Amex. Then we have Coca-Cola. When Coca-Cola was less well-known than it is now and still struggling to recover from the Black Monday crisis with shares that had been sharply undervalued, Buffett made an investment in the company in 1988. Buffett invested a total of $1.3 billion in the business to acquire 6.2% ownership by 1994 after seeing the brand's potential. Coca-Cola's current status as one of the most recognizable brands in the world demonstrates Buffett's great sense of potential. And ultimately, his investment paid off. In reality, even considering the dividends he received over the years, which totaled about $10.2 billion or a 54% annual rate, it is projected that his holding in Coca-Cola, currently at 9%, has risen to a staggering $24 billion. Then comes Wells Fargo. He started investing in the business in 1989 with a $290 million investment for a 9.7% interest, which increased to 13.3% in 1994. He was attracted by the company's low price while still being a well-managed bank with lots of potential. Wells Fargo is one of the biggest banks in the world as a result of continuous investments made throughout the housing crisis, and Buffett's investment in the firm has been very successful thanks to dividends and consistent stock price gains. It is evident since his stake in the firm peaked at $12.7 billion in 2016, with a market value of $22.1 billion in the same year. Meanwhile, Buffett sold a substantial amount of equities throughout the years, but slowly, and in early 2022, he severed ties with Wells Fargo and liquidated the majority of his holdings as a result of the bank's business troubles, legal troubles, and moral failings. Nowadays, Coca-Cola and American Express are both regarded as blue-chip companies in the modern market. Yet, Coca-Cola is often considered the most valuable brand in the entire globe. Despite recent difficulties, Wells Fargo continues to be a major participant in the banking sector. Applying Buffett's investment ideas, which have evolved into a handbook for many investors hoping to replicate his success, can help an investor's portfolio be successful despite the fact that investing can be a challenging endeavor. First, concentrate on long-term investments. Buffett is renowned for emphasizing long-term investing strategies. He thinks that the greatest strategy for generating significant revenue is to keep stocks for a very long time. Imitating this entails resisting the need to trade regularly and concentrating on the fundamentals of the businesses you choose to invest in. Investors shouldn't let short-term market volatility deter them from their long-term objectives. Second, seek reputable businesses. Buffett has switched from Graham's quantitative-based investment to quality-based investing with the assistance of his business companion Charlie Munger. This implies that they should focus on the fundamental quality of the company rather than buying decent businesses that are priced affordably, because this will affect its success over the long run. Third, purchase undervalued stocks. Buffett is a value investor, which means he seeks stocks that the market has undervalued. This entails searching for businesses that have solid foundations but are trading below their true value. Purchasing undervalued stocks can offer a margin of safety and the chance for substantial gains when the market ultimately realizes the full worth of the firm. Fourth, maintain a concentrated portfolio. Buffett is renowned for keeping a small number of stocks in his portfolio and concentrating on those that he believes in the most. This strategy has the potential for big rewards, even if it might be risky. However, in order to be sure that each investment is, in fact, a high-quality firm with solid fundamentals, rigorous study and analysis are crucial. Also, keep in mind that Buffett does not totally endorse diversification, even if it is a safety net for certain investors, since, at the end of the day, each individual has a different risk tolerance, level of investing expertise, and personal financial condition. There are no guarantees when investing. However, adhering to these guidelines and focusing on long-term goals could help raise your chances of making profitable investments. Start by being familiar with investment fundamentals before taking on this task. After that, examine firms and learn how to interpret financial accounts. It's crucial to just invest in areas which you are proficient, since a jack of all trades is rarely skilled in them all. Buffett's investment approach has received a lot of attention and praise for being straightforward and successful. It sounds like we've reached the end of this video. If you found this video helpful, please hit like and subscribe and comment down below your thoughts in the comment section. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. See you next time!